Hi there, Deontay. All right, so we are going to get started here. Deontay, let me know that you can hear me online, whether you just put a thumbs up or unmute yourself. Just let me know that you all can hear me before I get started. Welcome, welcome. Hi, Jana.
Yes, I can hear.
Perfect, perfect, perfect. All right, so I am Danekia Smith, for those who don't know. I also actually got started in the credit repair industry after working in the banking industry for several years and seeing so many people that could not actually get qualified. During credit repair, most of the people that were trying to repair their credit was looking to purchase a home. And so I was sending my clients to different realtors in the metro Atlanta area. But as you know, if you don't have a license, you cannot benefit financially from those referrals outside of like a Starbucks gift card or an Amazon gift card. Hey there. So I initially got licensed as an agent just to refer business to other realtors because, as I stated, I was getting so many clients who were trying to buy a house who did not have the credit score to do so. And of course, now I am full time, full throttle with real estate, but I still also help people with their credit. So I want to make sure that us as licensed realtors, we understand at least the basics for credit so that you're able to have conversations and you don't lose your clients. Because what typically happens is you have a buyer, they're ready to get qualified, you send them to a lender, your lender says, hey, they need to work on their credit, or hey, they're not ready yet. Most realtors are losing those sales because they don't have a solution or a tool or a resource to plug those people into and keep them in your pipeline. And so we want to make sure that you're going to understand your credit scores. This also will let your clients know, because some people say, well, is credit really even that important? I have cash. Well, guess what? Even if you buy a house cash, you have to insure it. And guess what? The insurers also run their credit to give them their insurance premium. So it's not really a way to get around not needing credit, even if you have the mindset of, I'm a cash person, I do everything in cash. Uh-oh. Okay, so what is a credit score? The credit score is a number that is going to show that you are reliable, you are trustworthy, and they can expect to get their payments back. They look at your credit typically over a 12 to 24 month time frame, but we know that there are some items on our credit that can remain on there for years. So they may see you had a collection 3 years ago or a late payment. Late payments, and we're going to talk about what makes up your scores, your credit scores, but late payments will hit your score and weigh it down the most. One late payment could cost you anywhere from 30 to 50 points and onward. And as I mentioned, it's not just lenders that take into account your credit, but also your insurance and even some employers. And a lot of times when I tell people that employers look at your credit, and we know not every career field requires a credit score, but there are some, especially the financial industry. If that is a part of your hiring requirement, if you have less than perfect credit, then you can cheat yourself also out of a job. And most people do not realize that. Okay, these are some of the stats, and I want to hear your feedback. You all let me know, but did you know that 46% of real estate transaction problems are triggered by some type of financial issues, whether they don't have the credit or even the down payment assistance? Most recently, I have a young lady that has not been on her job for 2 years. That is accounted for as financial issues. 56% of all consumers have subprime credit scores. Do we know what a subprime score is? All right. Those are the scores where you can get qualified, but you're going to have a very high interest rate. So in the 500s, there are some lenders in real estate that will accept a client at a 580 credit score. Now, I tell my clients and the people that I deal with, I don't want to just get you qualified. I want to get you qualified with the best terms. I'm setting you up for failure if I let you go get a house with a 580 credit score, because your interest rate is going to be through the roof as in comparison to your neighbor who may have the same exact home layout, same exact home, but their credit is better. You're paying more for the same exact home. And I don't want them to be in that type of situation. So I always try to let them know, hey, I don't want to send you to anybody that's going to accept you for 580. I actually don't even have anybody. But I know there are lenders out here that will accept a 580 credit score. But I feel like our duty as a realtor is to set our clients up for success. Now, why do credit scores matter? They determine if you are eligible for a loan or a credit card. But beyond that, I tell individuals your credit score determines the type of lifestyle and livelihood and even neighborhood you're going to raise your family or your children in. And some people don't think about it in that mindset, but if you have a higher credit score, you're probably going to live in a better area in comparison to having a less than perfect credit score. Interest rates are going to be higher, not just interest rates, your insurance. And I'll even dig a little deeper with insurance because I think most of the times our mind goes to what type of insurance? Is that what you said? Homeowners insurance, flood, life insurance. That's one that most people don't get. Life insurance is also dictated upon your credit score. And if you look at the fine print, if you have a life insurance policy, it absolutely will tell you they are running your score to determine what your premium is going to be. We know that renting an apartment, it can impact their ability to rent. We already talked about getting insurance. And as I mentioned, even gaining employment, keeping employment, and even getting a raise on a job could also be dictated upon your credit score. So we're going to talk about the 5 components that make up your credit score, and we're starting with the one that weighs the most. So when I talk to clients and they maybe are not just ready yet, I am sure to tell them, make sure you pay your bills on time. If you don't do anything else as we're working to build your scores up, because as I mentioned earlier, one late payment could literally plummet a person's credit score. And again, to lenders, they're going to think, if you can't pay your credit card, if you can't pay your your car loan, are you really going to be able to pay me back in the form of a home loan? You're going to be considered risky. So make sure that they pay their payments on time. I'll even tell them to set up bill pay or automated pay. And I know some people don't like that. I don't want people drafting out of my account. But if that's the way you have to ensure your bills are going to get paid on time, please do that. And also, cheat code, on time is not more than 30 days late. We know people run into issues financially. Something happened, you got to fix something in your home, and now you can't pay your bill that's due on the 1st, now until the 14th, the next time you get paid. That's actually okay. It's when it goes 30 days late, that is when the creditors are going to report to the bureau. So if your bill is due on the 1st and you can pay it on the 29th, great. But if you let it go until the 1st of the next month, it will impact your credit score. This goes for all accounts, especially even student loans. I know firsthand. I actually got very passionate about credit repair because student loans, if you've ever been to college, they give you those loans every semester. So those are reported to the bureaus as individual loans every single semester, not just one semester that you went to school or, the full tenure of your time. I had 12 student loans that came out of deferment. I was unaware. They sent it to my college address, not my current address, and that resulted in 12 late payments in my credit report at one time because they are individuals. So if you have clients that have student loans, always tell them to either have them in deferment or have some type of payment plan, even if it's them contributing $10 a month on a payment plan. Because if no payment, they are going to report it to the bureaus and it is going to plummet their scores. And you want to know everything that I'm going to discuss, everything can be removed from your credit report. There is nothing legally that says anything has to be on your credit report. So even if a person does experience a late payment, a hardship, there are things that you can do to get those removed or even forgiven with the creditors. The next biggest chunk is credit utilization. For my agents on the line who's been in real estate for a while or even speaking with or spoken with a lender, what is one thing you'll hear a lender say? And online, y'all can unmute. It's no wrong answer. Anybody want to try? What is something in regards to credit utilization that we hear lenders say as to why the person? Say it again.
DTI is too high.
There we go. DTI. DTI stands for debt to income. That means the income that this person has is not sufficient to the amount of debt that they have, and it will throw them off. This could include car loans, credit cards, and any type of trade line. If an individual has a credit card, whatever that limit is, multiply it by 30%. We'll use easy numbers like $1,000. $1,000 credit limit, they should not be using more than how much or carrying how much each month? Close. $300, because 30% of 1,000 is 300. So I just actually had someone recently, I'll tell them, I'm not saying you can't use more than $300 because life happens, right? You may have an emergency, you need to use $500 this month. But you want to make sure by the time that your creditor reports to the bureaus, and this date could be different, it is not the same as your payment date. Your payment date may be the 15th, but they report on the 12th, okay? Or after that date. By the payment close date, statement close date, that should be at $300 if it's a $1,000 limit. If it's more, it's going to negatively impact their credit score. So using too much credit can hurt your score. It shows the lenders that you may rely too much on credit. You want to keep that usage under 30%, and staying below your total limit shows credit responsibility, and it helps you to improve your scores. I'll also give you all another tip, which is individuals who have these store credit cards. And if you've been, oh, you Gina, you came in. Look at it. If you may have experienced, or you have clients that say, oh, I just went at TJ Maxx, I can save an extra 15%. So I applied for a credit card knowing my credit is bad. Store cards are the worst cards to get. They carry the highest interest rates. And one thing that I tell my clients is, if you're doing it to save money, ask them to add you to their email or their text message list. They're going to send you the same exact coupons as the people that hold these credit cards. They cancel it. Yep, and that's with all cards. All cards. I do experience people that say, hey, I got into debt before, I paid off my accounts, I just want to close them because I never want to experience this again. If you close those accounts, it erases all history, all activity associated with that account, and will lower your scores. So the thing to do is just to be responsible with it. If you pay it off or pay it down, just now use it responsibly and keep it below the 30% utilization to maximize your scores. The next biggest piece of your credit is length of credit history. How old were you when you opened your first credit card? Who wants to share? 13. Wow. Look at that. What about you? 18. What about you? 20. Okay, I got my first one at 18 too. You go to college, a lot of times they have those little tables with all the bankers and everybody. Come get a free t-shirt or water bottle, and you done signed up for a credit card. Didn't even know it. I started mine at 18. Zales. Oh, wow, you was getting some jewelry. With some little diamonds. Diamonds is a girl best friend. Yes, Learners, New York and Company, right? I remember their New York and Company. Yep. But length of credit history, a hack also, if you have children, you heard Renee say that she had her first card at 13. Most lenders and creditors will allow for you to add your children to your credit profiles or to your cards. I personally, Navy Federal is a great one. All of my kids are on all of my accounts. If you're building great credit history and credit, let your kids ride off of your credit. That's how you set them up for success. Most of us don't get cards until 18. And when we get them, did we know what to do with them? Did we know how they work? Did we know the importance of how much each of these items weigh? Most of us don't, because we don't get financial education at home, or it's not being talked about around the kitchen table. So, length of history. How long have you used credit? Lenders prefer to give or loan money to individuals they see can handle credit and have been doing so over a great amount of time. Older accounts are better. I do run into a lot of people that have maybe 1, 2 years, but I'm actually running into a lot of people these days that do not have credit at all, whether they're afraid or they heard a story from somebody else and they never want to experience it. And it's not about being afraid, it's just about being educated and using it correctly. Start early and build gradually. That's what I'm sharing with you in regards to if you have children or young ones, putting them on your credit. So when they're graduating high school at 18, 17, they're walking across the stage not only to get a diploma, but with a 720 plus credit score. And what a grad gift that would be. The next 10% is credit mix. I run into a lot of individuals that may have one type of credit and not the other. Lenders want to know that you can handle multiple types of credit. What are the types of credit? Installment and revolving accounts. Installment accounts are your car loans, your home loans. Revolving accounts are your credit cards or trade lines that you may open up. You want to have a good mix. I also even tell clients, though, don't go get a car before you get a house. Because when lenders look at your profile and they have to assess and determine, is this person really going to pay me back? Where are their priorities lying? If they see you went and got a car first before you got a home, to them, they think you're going to pay your car loan if something happens or you fall on hard times. You're going to prioritize that car because you got it first. But you got to have a good mix, okay? As long as you, lenders prefer borrowers with a long, stable credit history. It shows experience in managing credit over time, as I mentioned. It also proves you can manage various types of credit, and then don't just open new credit accounts just to have credit accounts. You want to have a purpose. And I think this also ties back to those retail cards. So many people get caught at that register. You want to save 20%, or you want to, whatever the promo is, and we're just signing up for those cards. And you may even go in there once or twice. You don't even go in there regularly to even use the card for the discounts that you're signing up for. So it's only 10%, so you're only saving tax. That part. My response is literally, I don't need it to spend money, right? Yeah. And if you don't sell rack, it's more than 10%. Absolutely. And if you typically, most retailers have email and text message marketing. Sign up for that. They're going to send you the same 10%, 15% discount. It's not major when we think about our credit. That too, right? Because you got clothes, you got stuff to wear with tags on it, still in your closet. New credit application. So if we do get caught up at that register, you're going to also experience an inquiry. I actually just spoke with a young lady on Sunday that is now interested in buying a home. She just bought a car in March. We looked at her credit profile. Do you know how many inquiries she had from going to buy this car? Throw some guesses out. 5, 10, 8. Somebody online. How many times you think this auto dealership ran her credit?
7.
7. Okay, all of y'all are way too low. They ran her credit 25 times. 25 times. How does this happen? One, of course, we're not educated. We don't know what we don't know. And we go into the dealership. Our heart is set on getting a new car. We're not asking them, hey, where are you running my credit to? Who's looking at my credit profile? And when you have bad credit, they shop you around to 20 to 25 plus lenders, because I've seen more at one time, looking to see who's going to pick this person up. But that accounts for individual inquiries. When you have great credit, you can go into your bank or your credit union. Hey, I'm ready to buy a car. Navy Federal, you can go online, get my pre-approval, go pick my check up at the bank. They ran my credit one time. Now I go on to the dealership empowered, knowing nobody's going to run my credit, and you truly get to pick what you want. Because let's face it, when we got bad credit, they shopping us around to 25 people and they're going to tell us what we're going to get. You don't typically get what you want. They got to make the numbers work for you to actually have a car payment or a one that you can afford. But also on top of that, you got to get what on a car? Insurance. This same young lady, car note is $400+ a month. How much do you think her insurance is? 6, 5, 5. Car insurance. Mm-hmm. For 6. It is absolutely $500. So then you're talking about I'm paying $800 plus to ride around in a vehicle. So now if you go try to buy a home, you can't afford this because they can see that. Never. Yes, absolutely. Because remember again that credit score dictates what the insurance premium is going to be, as well as that car loan. Now, of course, there's always hope, right? Make some payments on time, then go refinance, and then get them to do what's called a re-rate. This is something for everybody to know. If you have bad credit right now and you go and get car insurance and your score improves, you have to call them, the insurance companies. Hey, my score has improved. I need for you to do a re-rate. It is free. It does not impact your credit, but if you don't tell them to do it, you're just going to be paying higher premiums just because you don't know. But you all know because y'all in the room. Applying for new credit often can make your score go down a little if it's 1 to 2 to 3. But in the case of 25, one inquiry accounts for 3 to 7 points. So you do the math on that 25 inquiry times 3 to 7. I think it ended up 3 to 7 points per inquiry. Also, when it's time for your buyers to go and apply for a home loan, you should be telling them to shop around. You should not just say, hey, go apply with this one person. Let's see if we can get approved. As a new home buyer, when you're applying with the lender, you have a 30-day window. You can apply, let's say, to 25 lenders. It will only account for one inquiry if it's done within that window of time. Now, we know sometimes things happen, right? We start with one lender, and then in the middle of the transaction, something happened, we have to switch. Now, if it's after the 30 days, it will be another inquiry on their credit profile. And again, that's why I suggest and recommend having them to apply with more than one upfront. When I send my clients my email, hey, it's time for you to get qualified, it has 3 different lenders because we can't actually just provide them one, right? Because that would be steering. So you have to give them multiple options, but also knowing that, hey, apply to all 3. Some of them offer different programs, different rates, different things. Let's see what works best for you, but most importantly, just know this only impacts your credit once. Not everybody cares about their credit or know that this is going to happen, but for those who care about their credit, they typically are going to ask you, well, are they going to put an inquiry for each one or how many points? They'll ask about it. But now that you know, you can incline and educate them and let them know. Checking your credit score. How often are we checking our scores in the room personally? Once a year, twice a year? Okay, how many once a year? I get notices from 2 different banks all the time. Okay, what is you, Monica? Every month. Okay. Every day. Okay. At all? Oh, it's daunting. Okay. Okay. But you know it changes, right? It can change every day. But I'm not doing good enough, so it ain't changing. Okay. You gotta feel like we're doing good. Okay. All right. Or we can face reality, right? And come up with our game plan of how we're gonna get it where it needs to be. But a good practice, I recommend at minimum at least twice a year. You get 2 free reports with the bureaus every single year. You can set that up. But most platforms, you got like Credit Karma, which is not 100% accurate, but there are some platforms out here that will allow for you to see your credit score way more frequently for free, more than those 2 times a year. But you need to know that you can request your reports and get your reports twice a year for free. Sometimes when there are breaches and different things that happen, they actually happen quite often, more often than we actually think or know, because they don't publicize all of them. But if you go to some of the credit bureau websites, they'll actually tell you, hey, you can see your credit report for free for 6 months, or you can get your scores. All these, they have different things that they'll run because they've had some type of breach that has happened. Checking your score, your credit score and reports does not impact your credit. Some people think, well, if I go look, it's going to lower my score. No, it's not going to lower your score. And you should also know the difference between a soft inquiry and a hard inquiry. Do we know the difference? Okay, it'd be a pre-approval, but what's the difference between soft and hard? That's correct. When you do a soft pull or soft inquiry, it does not impact your scores. If they do a hard pull, that's what impacts their scores. Some lenders will only do a soft pull to do the pre-approval and then kind of see where they're at. If they're ready, then they'll move forward and actually do a hard pull. I actually prefer lenders like that, especially for my clients that may not know where they're standing. But I'm going to give you some additional tools as well so that you can know where they're standing before you even send them. Because we like to save time and not waste time, right? Absolutely. All right. So your credit scores impact and affects 3 areas of the mortgage payments. PMI, this is mortgage insurance. It is risk-based, and the lower the score, the client will be forced to pay. Not everybody pays PMI. So when you're looking at your closing disclosures with your clients and you're going through it, being able to identify that they are paying PMI, now I can tell them, hey, we got to make sure you're making on-time payments once you get into this home, because PMI will fall off. But it's only when you're showing them you're no longer a risk. But that gives them something to look forward to, knowing that, okay, my mortgage can go down once this falls off. PITI, this is principal and interest, taxes and insurance. This is interest and is based on the credit score. Homeowners insurance premium is also based on their credit score. So if they have bad credit, and we know insurance is going crazy right now, but if they have bad credit, it's going to be even worse. So just make sure that they know the credit score impacts so much more than just getting qualified to buy. It plays into many factors. This is a little blurry, but this is an example of just showing you someone, Henry and Dolores, as an example. Henry has a credit score of 750. Dolores has 630. Most people, 630 is not that bad. My lender only requires 620. Well, it's not that bad until you actually look at the interest rates and the difference in which they would pay. Going back to the example I gave you all earlier, well, we can go into a new construction neighborhood that has the same exact floor plans throughout the neighborhood, and you literally could be living next to your neighbor with your 630 score, paying 7.65. Your monthly payment is going to be higher than the person next door that has 750. Over the lifetime of the payments, how much you're paying, and what's the, oh, they got runs. How is runs? It's supposed to say Dolores. The difference though in the amount that she's paying because her credit is lower. Same thing in this example, is just a different price point, but you get the point. You're going to pay more for your home, even if it's right next door to your neighbor. Y'all got the same exact house. You can pay more because your credit score is lower than your neighbor's.
We don't point that out what they're paying in interest. Most people, you always say, people think in monthly notes. They don't think in that, right? So, when that, their monthly note range were good, when they realize they're paying an extra 100,000 plus, that's a big deal.
Huge deal. And then it increases your even competitive advantage when you understand this and you can sit down with them after their closing or the few days before. Hey, I know you had a 630, but our goal is to get this score up. You can refinance. Do you know how?
And maximize your equity. This minimizes their equity.
Absolutely.
It takes longer to build.
It does. And do you know how many people during the pandemic could not refinance because of their credit? The interest rates were low. Like, I think we refinanced and got 2% interest. But do you know how many people that could not benefit from that? Or the people that may have to put their payments on the back end and delay their payments? If you're doing that, your credit's probably not good. And now you can't benefit from that. So being able to speak to those points and really set your client up for success. I also even mentioned sometimes you have people that want to pay a little extra on their loans. You know, maybe my loan is $1,500, but I got a bonus this month for $500. I want to put an extra $200 towards my home payment. Do we know how to tell them to apply that $200? To the principal, to the principal. This is for car loans too. I asked that question because it's a lot of people that don't know. I just submitted the extra payment. How do I still owe this amount? You have to tell them where to put your money. And oftentimes when people say, I'm trying to figure out where my money went, it went wherever you sent it. You have to tell them, I'm giving you extra too, but I need this to go to principal. If you're doing it online, I know with my mortgage company, it actually has a box. I must click that for that extra amount to go towards the principal. Any questions about any of that? All right, so I want to give you all a few tools that you can put in your toolbox, and I'm going to send out the links as well via email to everybody, even if they did not attend today. Do you all know about rent reporters or ever heard of it? All right, most of our clients that are trying to buy, they are what? Renters. They can get credit on their credit report for on-time rental payments. This company, and there's probably a few other options out here, but I'm going to speak specifically for this one because I've worked with them. They will go back up to 1 to 2 years of payments. So now you're talking about the history being added, and that accounts for how much? Let's see if we remember. How much does history account for in the credit report? No.
History?
Length of credit history. 15%. So now you're talking about 15%. On-time payments account for how much? 35%. So now we're talking about what? 50? That's 50 points or percent.
Payments count for 35%.
Correct. And length of credit history is 15.
I got that.
So that could potentially increase your client score. And remember, on-time payment is not paying how much late? How many days? 30. So even if this renter paid 10 days, 15 days late, it still will report as an on-time payment. So especially for the clients that don't have bad credit but just need a few more points, this could be a game changer. Of course, it costs money. It's not free, but it's worth it if their ultimate goal is to become a homeowner. When you want to know what your client scores are for mortgages, because the scores vary across the industry. The score that the auto dealership is going to see is completely different than the lender. What the insurance company is going to see is completely different from those two as well. My FICO is going to give them mortgage scores. This also costs. It's not free. But for people that say, I don't know where I'm at, and you don't want to waste your time or their time or your lender's time, send them here so we can kind of know where, and it will show them all three scores. We know that lenders take which score to qualify them? The middle. The middle. They line it up from least to greatest, and whichever score falls in the middle is the score that they're going to use. So if you're using myfico.com, you already know, hey, my person is at a 650, 700, or whatever the case may be. Smart Credit is another credit monitoring tool. I actually use this with my clients that I work on their credit. This tool allows for them to see all scores: mortgage, auto, insurance, and hiring risk index, which is the employment score that we mentioned earlier. Also, if there's anything hindering their score, this tool will allow for them to communicate directly with the creditors through that platform. It will even show them how to maximize their score. So if they have credit card balances that are above the 30%, it will literally tell them the dollar amount. Hey, you need to pay this down to $172 for your score to maximize. And if they do it, they'll see the results, and it actually tells them the date of when the score will actually update, so they can actually pace themselves. How many of y'all pay utility bills? Subscriptions, Hulu, Netflix, phone bills. Well, guess what? We know that utility bills do not report to the credit bureaus. But if you are paying, and actually this is an exercise we're going to do in here today, so then y'all can say this class was worth it. You go to Experian Instant Credit Boost. Let's Google that or pull it up on your phone. Mm-hmm. It brought your DTI.
So the mortgage companies, they see that.
Uh-huh.
So when I applied, I was trying to build on a house, and I went to apply for it. And they say that your bill is not this much. So they see those bills.
Mm-hmm.
So that adds to that.
Oh, really?
So yes.
I haven't had that happen.
Mm-hmm.
Okay. Well, do this at your own risk. Okay. But from my experience, yes, you can take it off, but this is a free tool through Experian. If you go there, they will scan your bank account for any bills that you're paying, light, water, internet, cell phone, the subscriptions. And if those are reporting, it reports directly to the bureaus and instantly boosts your score. It should actually tell you how much is boosting it on your screen if you do it. Okay, and it does not matter if the bills are in your name, because I know we have situations sometimes, maybe you stay with your mom or a family member, the bills aren't in your name, but you're paying them from your account. They will still report it to your profile and boost your scores. Oh, my other ones got cut off at the bottom. Anybody bank with Navy Federal Credit Union? To me, they have some of the best like credit building tools and resources. They offer secure credit cards. If you have or your clients have at least $200, that's the minimum, in their account, they will give them a secured credit card. Do we know the difference between secured and unsecured? Correct. So secured credit cards requires for you to put the deposit down to establish the credit limit or line. In this example with Navy Federal, the minimum you could deposit is $200 to open up this. Unsecured card is when the creditor is looking at your credit. You got good credit, great. I'm gonna just give you $2,000. You ain't gotta put no money up or anything. So that's the difference between unsecured and secured. Navy Federal also has something called a pledge loan. These are credit building options for clients. If your client has $1,000 in their account, Navy Federal will give them a loan based on that. They still have to use it responsibly, pay it back, all of those things, but it reports to all three bureaus and could take a client from unqualified to qualified if they're missing trade lines or credit on their profile. This is cut off at the bottom, but it says self-lender. Anyone heard of self-lender before? All right, or Credit Strong. These are installment accounts. So remember, we got to have a good mix of credit. How much percent is mix of credit? 10%. So we have to have installment and revolving. These are installment accounts that will report to all three bureaus. It is essentially a savings account. You get to select how much you want to save each month. I think the lowest is like $35. But once a person does that, it immediately reports to the bureaus. Now, they must continue to send their $35 into their savings account. They can elect to do it for a year, 2 years. At the end of that time frame, they can get all of their money back, but they also just built their credit in in that time frame. They do charge a fee at the end. So if you did 500, they're not going to give you full 500. It might be like 475 or whatever their rates are. But it's a great credit builder. I believe this is the last slide. Do we have any questions about credit? Yeah, that's the last one. What questions do we have? Beneficial? Was this beneficial? Okay.
So if we see an error,
Oh,
what's the best
good.
course of action for that?
Great question. We are all protected under the Fair Credit Reporting Act. As I mentioned earlier, nothing has to report to your credit legally. So under the Fair Credit Reporting Act, anything negative, erroneous, obsolete on your credit profile, you can dispute. I mentioned smart credit. Smart credit will allow for you to dispute or negotiate with some of the creditors there directly, or you can choose to mail out letters. You can do this completely free yourself. You just need to know what you're doing.
Mail letters to the 3
credit bureaus for the items that are reporting. Also want to mention, not all creditors report to all three bureaus. Why? Because it costs them money. So you could see a credit card on 2 of the bureaus and it's not reporting on the other, or 1 and not the other 2. They have to pay to report to each one, so some of them elect not to report to all 3. This is why you will also see variations of how many negative items is on one report versus the other. This is also why your scores are different, because not all lenders report. So you will want to pull your credit profiles to see which items are reporting. And if you need to dispute, then you send that letter directly to that bureau. You need to include verification documents. You cannot just send a letter. It includes like your license showing the address that is on your profile, or utility bill, and a utility bill. Something showing your address and your name. If your name varies, cheat code. Let's say you got married. You're now Danekia Bailey versus Smith. If something negative is on your credit report reported under that old name, that can be removed because it's not 100% accurate. That is not your name. That is not your name. If they have an open date wrong, if they have the balance wrong, those are like common errors. The names, the addresses, take all old addresses off your reports, all old names off of your reports, and then go through the dispute process if you have items on your credit profile that are negative. What other questions do we have?
So processing wise, it's wise to go to each bureau, pull their respective reports, obviously compare,
Mm-hmm.
and then just according.
Correct. And you can even say, hey, you're reporting this debt as this, and it's completely different than this bureau. There's an error. I need you to investigate and remove this from my profile. Legally, they have 30 days to respond to those letters. If in 30 days they don't respond, they forget, and this happens a lot during like holiday time, end of year, people getting lazy, they're not going through the paperwork. That's not your problem. It's actually great for you. If they forget, they don't do it, they have to legally remove that from your credit profile. 30 days. And you are also protected under the consumer CFPB, CFPB. Let me not even try to.
Financial protection
Bureau. There you go. CFPB. So if they're not responding, or you don't like their response or whatever, go there and submit a complaint. And then a lot of times it also gets removed as well, especially if they're not giving you a response within 30 days. Sometimes they send what we call stall letters and saying, hey, we don't know if this is truly you. Can you call in and do this? It's stalling. No, get this off my credit report. You got 30 days. This is me. This is me. Any questions online? Let's say somebody talking, but let's see. Okay, maybe nobody. Yeah, and Kyoku, yes. If it's no questions, I hope you all got value. I'll send out these links and things to you all via email. And of course, if you have questions, I actively do credit repair, so I can answer any questions that you may have, whether it be for yourself or even a client. But I hope this was beneficial to you all.
Thank you.
You're welcome. You're welcome. You say it stretches you out.
Big deal.
It is, and it